Canada doesn't get to decide inflation. It is a global phenomenon. We have no ability to really influence it. So why pretend that we do?
Welcome back to another episode of Tank Talks. On this week's episode, we skip the interview and go right to the weekly rundown show with John Ruffalo. Welcome back to the Tank, John. How you doing?
Great. How are you?
I'm pretty good. I got to see you in person at a very nice dinner that you were able to host for us. Thanks so much for inviting me.
Great. Awesome.
I also just got back from Invest Canada, where we were in Montreal last week, where the private equity and venture capital industry gets together every year. I didn't see you there, but you were missed. And our good friend from the podcast, Baron Davis, made an appearance thanks to the podcast. So it was great to see him in person. We had a very fun time in Montreal. Got him to show him around some good places. Speaking of Canada, Canada's AI darling pulled off their fundraise. As reported by Reuters, the $450 million investment into Cohere has been announced, including NVIDIA and Salesforce Ventures again, plus some new investors, as we've talked about, Canadian pension fund PSP, as well as Cisco joined the round. So I'd love to hear your thoughts on this. Obviously, there is still a huge amount of demand for 125 times revenue deals out there in the AI space. But what are your thoughts on this after being talked about in the media for months?
Well, I'm thrilled that they've been able to get this financing. I think that they were they're still not finished, as I understood. I think they were trying to target $1 billion, but this is a nice chunk of change. You and I have talked about. It is very much a space race. So the ability to raise as much money as fast as possible is really a competitive advantage. And the real question is going to be and it's not just for Cohere, is how long is the excitement going to last on the Gen AI space in terms of the thirst for funding? If you saw the U.S. venture capital report in Q1, the results were quite muted, but it was a tale of two worlds. The AI-based businesses were financed at a significant premium. I think it was a 40% premium to the average of the rest of the pack. In Canada, we don't have as many investors, so it's hard to really see the true impact. So the question in my mind is, how long is this going to happen for?
Yeah. I mean, look, they're raising up to $1 billion, as you say, at a $5 billion valuation. Their revenues have grown, but obviously not as much as what would some think, given the valuation they were given, going from 13 million last year up to 35 million on an annualized revenue run rate this year. I think the interesting thing is that we're seeing, obviously, Anthropic, raise their fundraising round, and hearing some amazing things about their performance from some insiders I know there. Is there still room for another frontier model platform like Cohere when you've got such a massive head start with Anthropic and obviously OpenAI and then Google, and now with the $6 billion that Elon Musk raised for XAI, how many more options do people need?
Llama, open source option.
Llama, exactly. With SAP, they partnered with as well. So I get why NVIDIA can throw money at a bunch of these things and see what sticks. Salesforce Ventures, after the quarter they just reported, maybe not as aggressive as they were. Seeing Cisco come into this one, and then obviously PSP, it just made you think, how many other investors may have said no to this potential investment?
Yeah, I know, but I'm going to stick to my guns of the rule of three for infrastructure type investments like this. So no reason why they can't be one of the three, but it's not going to be a lot of winners in the space.
No, absolutely. And they're trying their best offering this startup package for Series B or earlier investment funds to obviously use it.
Wave that Canadian flag.
Absolutely. It feels like we're heading into another crypto summer. I mean, crypto is back, baby. There are so many people now jumping on the bandwagon, from politicians like Donald Trump to even obviously the naysayers in the Democratic side. It's unbelievable. But what's actually crazy is now you're seeing even more of the heavyweights in the mutual fund industry jumping in on the bandwagon. Franklin Templeton, a 77-year-old mutual fund heavyweight, is now putting their hand up and saying they're exploring a new crypto fund that will invest in a range of tokens beyond Bitcoin and Ether. It does feel like the ETFs is always that gateway drug for a lot of these fee collecting machines. What are your thoughts on this? And do you think we'll see more and more of the largest institutional investors put their hand up to launch a crypto ETF?
Yeah, we'll see it until there's it is kind of funny that the really smart money is coming up when the money's already been made and on the way up. And let's just hope that we don't have another crash again, and you will see people run for the exits. One of the biggest developments is when the U.S. approved ETFs for Ethereum, and that was a huge boost for Ethereum. That's something that we were expecting for quite a while. And you're absolutely right. To me, the real question is, outside of Bitcoin and Ethereum, all of the other currencies, what sort of legitimacy are we going to see there? And one of the problems is that, we've talked about this before, but there was a lot of bad actors in there that took advantage of a lot of retail investors. So I just hope it doesn't happen again, or else we're going to have, again, another implosion the other way.
Yeah, but what's interesting is that now it's becoming a lot more politicized because of the potential benefits of embracing crypto as a way to generate voter interest from both sides of the aisle. And so you're seeing, Donald Trump put his hand up and saying Bitcoin is potentially part of the U.S., financial system. Now Elizabeth Warren and Democrats are saying the same. I think people are realizing that as the younger population becomes part of that voting majority, it's a big part of their life, crypto, right? There's 50 million Americans that own it. And so if you can kind of put your hand up and say, we are a political party that supports it, you might actually have one of the top voting issues for some of these constituents. So it's really interesting that it's become part of the conversation yet again after seeing a pullback last year.
Yeah, and what's a little baffling to me is that the reason why I love crypto is the underlying blockchain technology. That's what I think is absolutely cool and makes a whole host of sense. Yet the story happens to be just the applications being the cryptocurrencies really on top of these platforms. It is kind of funny that it is taking a lot of positive traction, but for really one narrow application of the blockchain.
Yeah, going from ETFs, let's stick with the public markets here, but a bit of a negative light. There was some negative news that came out of, one, the private equity side, and then two, on the public earnings side. So let's start with public equity side. Vista Equity has written off their PluralSight value. They purchased it from the public markets, at a $3.5 billion buyout, of which, assuming $1.5 billion was an equity check, the rest was funded with debt, which is obviously the PE playbook. But 3 years after taking it private for $3.5 billion, they've written off the entire investment from an equity standpoint. And this is just an example of how the leverage is obviously catching up. It's obviously expensive to finance this debt. And when you have a business like PluralSight that is getting hit in the face by, a ChatGPT competitor in the edtech space, even if you have 26% EBITDA growth, you're still not able to actually pay off those debt costs. I guess, what does this mean for the rest of the private equity space? Because people thought private equity was going to be the savior of maybe some of the venture capital bets.
This has been a long time coming. Buyout private equity in particular that leveraged off of using substantive debt leverage in order to achieve the returns had a tremendous run, but it really wasn't a value creation activity. So those private equity firms that solely relied upon this, knowing full well that eventually interest rates are going to rise and it erodes your entire ability to do a return, you're going to be in trouble. And a lot of the firms, and one of the techniques that's very common in a lot of firms, is roll-ups. So you're basically borrowing money and you're getting a multiple arbitrage. Well, that disappeared almost overnight, and a lot of the strategies went away, as opposed to folks that did a roll-up that were actually trying to truly seek out synergies and creating a much more valuable pie. I think the good news from this is the very good firms will focus in on that value creation. And a lot of these businesses will hopefully become stronger as a result.
Yes. And so just to be clear for our audience listening, there's the buyout private equity market, which is buying out like multi-billion dollar, 100% businesses with debt. And then there's the private equity business model that's buying majority of an asset with equity and some debt. But they're kind of separate issues here. We're talking about the buyout side where there's a lot of leverage on these businesses. The other thing that we're hearing, and I was, speaking with some large private equity firms in the States, as well as some large investment banking firms, and what they're seeing the private equity guys do is they're actually not looking to buy an entire asset, an entire company. They're looking to buy the individual assets inside these companies and carve them out. Because what's happened in the venture growth stage is there's messed up cap tables. There's a lot of dead weight on the business, but there is a golden diamond asset inside of some of these businesses that they want to own. And you know what? For some of the VCs that have written it off, if they can get 30 cents on the dollar by selling off that jewel asset, there might actually be some light at the end of the tunnel. And the private equity guys are chomping at the bit for this. Are you seeing a lot of that out there as well?
I see it more in the context of larger companies that have a number of divisions or a conglomerate of divisions, and they're either don't see the synergistic value of a particular business. And in the ideal circumstances that when there is a management team that is capable of running the business, but it doesn't, it's not a strategic fit to the organization. We're seeing more of those popping up, and those are wonderful opportunities because you get to back a management team that's been running this business, except now they can just focus in on running and maximizing the profit of their particular business without worrying about all the strategic benefits to the rest of the organization.
I mean, you did that with MyoVision, right? I mean, there was a funding round tied with an asset purchase, and it was a win-win for everyone. So
yeah, and it's in fact, this is the exciting part for Canada in that, we always talk about our inability to scale up, and a lot of the markets of our Canadian-based companies are in the United States. Funding for acquisitions of competitors that have great distribution channels, but perhaps inferior products, and we have some great engineering capability. What a great use of funds to target.
Yeah, absolutely. I mean, sticking with the Canada topic, we have still yet to see the capital gains plan released. What the hell is going on?
Well, I've heard some rumors that the Ways and Means drafting is going to come out shortly, but I'm stunned at how long this is taking. This is messing with Canadian investment, and what people do not appreciate. When capital invests in countries, they look for predictability and stability of the rules. When you don't even know what the rules are, you have a lot of people that are saying, you know what? I'm just sitting on the sidelines, and I can tell you definitively that already the chilling effect of the proposals and the capital gains have already taken effect.
Yeah, I mean, look, the House rises at the end of the month. There's still a $7 billion taxpayer shortfall, which they're hoping they're going to get this windfall that you were talking about of people selling assets before June 25th. But there seems to be really no intention to be able to put final legislation down on paper before the House rises. So hopefully maybe there's going to be some carve outs, or maybe there's going to be a hope that they pull it all together. But man, is it confusing as investors of capital in an industry that could be directly infected. Speaking of some people getting fed up with the rules, I'm sure you saw the news of a new stock exchange idea that has been populated out there in the media regarding the Texas Stock Exchange. The filing happened between Citadel and BlackRock for the SEC, raising $120 million from various investors as well. And they're describing it as the anti-woke exchange, where there's an opportunity to help companies who are not enjoying all the scrutiny that's being put on them from the disclosures from the NASDAQ and the NYSE. And this is being described as a more CEO-friendly exchange versus the NASDAQ and the NYSE, because obviously companies that are listed on the NASDAQ and the New York Stock Exchange are being forced now to report and meet diversity requirements or explain in their filings why they cannot meet them. What are your thoughts on this? And do you think we'll see more of this sort of ideation of trying to take back control of these businesses from regulators and obviously the woke mind, as people sometimes call it.
Yeah, well, you got two more examples that we just reported in this past week. So ESG funds globally, net redemptions of $40 billion globally. It is plummeting all around the world, not just in the United States. Remember, if the taglines were, well, if you focus in on ESG, history says that you'll have better returns. Well, the answer was no, you did not. The retail investors have spoken. Number two, the SEC was trying to regulate private equity and private venture in the United States for substantive increases in disclosures to their sophisticated investors. I can tell you that the investors that I have that are institutional are extraordinarily sophisticated and have as much data as they would like in order to make their decisions. And yet the SEC insisted that they needed to have even more disclosures. And I believe it was the U.S. Appeals Court had overturned it. And there's a question of whether it will go to the Supreme Court of the United States, which will likely turn it back down again. So there seems to be this wave of saying, not that some of these things were bad, but it swung so far to the opposite extreme. Hopefully it ends somewhere in the middle.
Right. Yeah, hopefully it does. It seems like we're definitely swinging the other way of the pendulum. Last but not least, we obviously got to talk about the interest rate changes from the Bank of Canada, as well as now today by the European Central Bank. So right now we've seen the first cut in almost 5 years. Can't believe it's been 5 years. 25 basis points, very well telegraphed, very much expected. Sign of relief, I guess, for homeowners, commercial, borrowers, things like that. But it did seem a little bit of a sort of like a handout, if you will, just to appease a lot of the market. The dollar sold off quickly, but then it's rebounded back to around 73 cents on the dollar to the U.S. market. But really, the things that are more worrisome are the rising in bankruptcies, the oil and gas industry, the price in oil and gas coming down a bit. What are your thoughts about this very tiny pausing or reduction in the Bank of Canada's rates? And they say potentially 3 more before the end of the year, but it doesn't seem like the U.S. market is budging.
No, so I was going to say there's two elements to it. Number one is, you and I have talked about it, this goal of 2% inflation rate in Canada is ridiculous. What you and I have said time and time again, having a broader range of 2 to 3%, and if it's 3-ish, Canada doesn't get to decide inflation. It is a global phenomenon. We have no ability to really influence it. So why pretend that we do? And even when they reduced this, they said it was a reflection of the inflation coming down, but it's still not anywhere near the 2%. So let's not get ahead of ourselves. The second thing is the United States has still not made a positive comment they'll do the same. And the difference is the U.S. is concerned on inflationary pressures, particularly on wages. In Canada, we're getting more and more concerned that the impact of these interest rates is causing a damaging effect on this economy. So what you're seeing is a difference between the trajectory of Canada vis-a-vis the United States. Europe is operating in a same trajectory in Canada, which is very ho-hum. And in some cases, like the UK and Germany, they're in recession. So that's why we're getting this tale of two worlds. So it's not really a time to rejoice. And the last thing I will say is I am concerned on the longer term impact on the Canadian dollar, in that it does make it more expensive for us, vis-a-vis, international goods and services.
Yeah, I think what people forget to realize is the impacts felt when you change the interest rates by a quarter basis point or so. They take a long time, several quarters to actually trickle through the system, right? But the dollar has an immediate impact on the day-to-day purchasing and selling of goods in this country, or exporting of goods, as we obviously know is a majority of what this country does. And so that's where people should be focusing on, not on this 25 basis point reduction here that is trying to, calm fears around inflation, which really is actually concerning is more, again, the productivity losses, the negative GDP growth, the things that are obviously more of a grander economic concern, rather than these 25 basis points. The other thing that I'm still waiting for some G7 country to come out is saying we are redoing the calculation on how we calculate inflation and PPI. And it's not going to happen, I know, but just come on. Everyone knows that what they are running on it's not proprietary.
Yeah. No, I know. And they're using adjusted calculations and they're saying, well, we're going to exclude energy and food. Oh, but energy has gone down. We're going to include energy this time. So, like, come on, guys. But you're absolutely right. While inflation is obviously, if it gets out of control, is extraordinarily damaging, the real issue in Canada, which has been for the last 10 years, is really productivity and the growth of our economy on a GDP per capita perspective. And that is where our focus really needs to be.
Yeah, I think we're going to need a little bit more than a 25 basis point cut to get the stimulus going in this economy. Until next time, John, thanks for jumping in the tank.
All right. Thanks, Matt.
Hey, everyone. Thanks for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcasts, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.